we're trying to forecast expected return, and we're going to do a 10-year outlook. And we're just looking at stock right now, and we want to use 3 different points. We want to look at what would the stock be if it remains 20% overvalued. What would the stock return be if it reverts back to its fair or intrinsic value? What would the stock price be if it goes down, if it's now undervalued by 20%? And our starting point would be, we are starting at a market that's 20% overvalued. Well, we're going to use a 7.2% rate of return to keep things simple. Rule of 72 is every 10 years, the investment doubles. So if nothing changes and we remain at a 20% overvaluation, which can happen, we could hold that. That's definitely a possibility. That $100 turns to $200 over 10 years, and that's a 7.2% rate of return, roughly. Now, let's say that this $100 stock reverts back to its fair value. If it reverts back to its fair value, that $100 would only be $60 and a 4.8% rate of return. If after 10 years, at that place in time, the market happens to be 20% undervalued, meaning that the price is at a very good, favorable price, $100 is $128. Annualized return, 2.5. So looking at the different periods of time and then the place in the market where we're overvalued or undervalued can very much determine or affect what your actual annual rate of return is. So if we're trying to make a forecaster might say, in 10 years, let's say that we're going to be at fair value. They're going to forecast that $100 in 10 years is going to be worth $160. Now, forecasters could do anything they want to. They could say, no, we think we're going to be 20% overvalued, we're 20% undervalued. You can run those scenarios, but that's what it looks like. Probably one of these 3 things. And it's just an easy example to look at. Now, I want to compare that to bonds. And let's shorten the time period. In my example, I said, let's look at a 4-year period of time, maybe a little bit more relevant to a business cycle. And we want to look at expected return of bonds and stocks. Well, bonds, let's just say that we remain at about a 3.5% interest rate in the US Treasury. And we're just going to keep this simple. And $100 after 4 years is $114.75. Now we do the exact same thing with the stock. We have 3 different prices, and we use a 7.2% rate of return if 100 to 132, 100 to 105, and 100 to 84. Now here's where it comes in, is that you're trying to make a determination, like, yes, over the long run, stocks are going to outperform bonds. But you also want to understand, well, we are quite a bit overvalued. What risk do we have? Intrinsic value is often used as a measure of how much extra price or more of a margin of safety, many analysts will refer to it as. And if you think that there's a probability in the next 4 years we may have a change in business cycle, and business cycles generally aren't that long, so if you're late expansion and you think you have 4 more years to have one turning point in the business cycle and it reverts back to its intrinsic value, a forecaster might say, I'm expecting in 4 years that stocks are going to be from 100 to 105. In that particular case, bonds would be more favorable than stocks. They're going to produce a higher rate of return. So that's one way to look at it. But this does come back to the time that the further that you're overvalued, maybe the more likelihood you hold bonds, but it's also you're not timing it. You're trying to figure out, let's maybe take some off the table, or if it does revert back to intrinsic value, maybe then we move back into stocks. So that's how it works. It's just not an all or nothing thing. Hopefully this is helpful, but that's some simple forecasting and just looking at maybe 3 simple scenarios on bonds versus stock.